have to take big risks. Or I would say, no pain, no gain. Hello learners, I'm Teacher Mimi, and for today's video, I will going to discuss a new lesson. Watch and learn as we embark to a new learning in business finance subject. Our lesson for today is about risk-return trade-off.
At the end of the lesson, you will be able to define the risk-return trade-off, explain the risk-return trade-off, and enumerate the type of risks. Are you all excited? Get your pen and paper. We will start our lesson with a short quiz. What is risk? A. A potential problem. B. Risk involves uncertainty. C. It might happen or it might not. Or letter D. All of the above. If your answer is letter D, you are correct. Good job. Risk is a probability that actual return is different from the expected return. What is return? A. Profit on an investment. B. Also known as a financial return. C. It is the money made or lost on an investment over some period of time. Or letter D. All of the above. If your answer is letter D, you are correct. Good job, learners! Risk-return trade-off is the concept that the level of return to be earned from an investment should increase as the level of risk increases. In making investment decisions, financial managers take note of the risk and returns of the projects they are entering. As recall, the story of Jack in the Beanstalk. In the story, Jack trades his cow for 3 magic beans. This is a very risky move for Jack since these beans may be fake and therefore worthless. Luckily, those magic beans grew into beanstalk that gave Jack the opportunity to gather riches beyond his wildest dreams, while fighting a giant along the way. Jack gambled in this transaction. Should Jack decide not to sell the cow for magic beans and instead sold it at the current market value, the story would be different. As we can see, the higher the risk, the higher the returns. But of course, if turns are, the higher the losses as well. This situation is also true for making financial decisions. Taking a higher risk gives you the opportunity to earn higher returns. Low-risk investment like treasury notes, also called risk-free instruments, earn a low and steady income flow. This introduces us to the required rate of return. It is the minimum expected yield investors require in order to select a particular investment. I hope that you all have gained learning in our first part of discussion. The lesson would definitely tells you if you don't try, you will never know. So, I have a question for you. How can the risk-return trade-off work in your real life? Broadly speaking, there are 2 main categories of risk: the systematic and unsystematic. Systematic risk is the market uncertainty of an investment, meaning that it represents external factors that impact all companies in an industry or group. On the other hand, unsystematic risk represent the asset-specific uncertainties that can affect the performance of an investment. The list of the most important types of risk for a financial analyst to consider when evaluating investment are the following: market risk, purchasing risk, interest risk, business risk, and financial risk. Market risk is a fluctuation of returns caused by the economic factors that affect all risky assets. Sources of market risk includes recessions, political turmoil, changes in interest rates, natural disasters, and terrorist attacks. Purchasing risk, also known as inflation risk. It is the chance that cash flows from an investment won't be worth as much in the future because of changes in purchasing power due to inflation. Interest risk is the risk that arises for bond owners from fluctuating interest rates. As interest rates rise, bond prices fall, and vice versa. Business risk refers to the possibility of inadequate profits or even losses due to uncertainties. Examples: changes in taste and preferences of the customers, strikes, increased competition, changes in government policies, and the likes. Financial risk is any of the various types of risk associated with financing, including transactions that include companies' loan in risk of default. It is specifically refers to the money flowing in and out of your business. I am convinced that you all learned something from our lesson today. To further engage you in our lesson, let us answer the following activities. Get ready with your pen and paper. For our first activity, directions, read and understand, choose the correct answer. What is the concept of risk-return trade-off? Is it letter A? The level of return to be earned from an investment should increase as the level of risk increases? Or letter B? The level of return to be earned from an investment should increase as the level of risk decreases? The correct answer is letter A. The level of return to be earned from an investment should increase as the level of risk increases. For our next activity, I will give you 1 minute to answer all the questions. Let us now reveal the correct answers. Congratulations to those who got all the correct answers. Good job, learners!
As we end our lesson for today, to test your understanding and skills, please answer the following questions.
What do managers consider in making investment decisions? A. The risk and return of the project they are entering. B. The risk and returns of the project they are closing. C. Trying to win big. Or letter D. Trying to risk even more. The correct answer is letter A. What kind of risk is related to the changes in purchasing power due to inflation rate? A. Market risk. B. Purchasing risk. C. Financial risk. D. Business risk. The correct answer is letter B. What kind of risk is related to the possibility of inadequate profits or even losses due to uncertainties? Letter A. Business risk. B. Market risk. C. Financial risk. Letter D. Interest risk. The correct answer is letter B. What kind of risk is related to fluctuating interest rates? A. Market risk. B. Business risk. C. Financial risk. Or letter D. Interest risk. The correct answer is letter D. In making investment decisions, what do financial managers ensure of? A. The higher the returns, the lower the risk. B. The proposed business will earn less than the risk-free rate. C. The proposed business will earn more than the risk-free rate since they need to compensate for the risk the investment will entail. Or letter D. None of the above mentioned. The correct answer is letter C.
Thank you, learners! Once again, I'm Teacher Mimi, and stay tuned in our next episode of our Puerto Princesa Dream TV.